So, Matt, let's start on the central banking front. The Iran fallout as of late has really moved out of that military kind of kinetic zone and moved into this financial layer. It seems like a lot of central banks have been kind of cornered into the what you're calling the bad quadrant. So, soft growth, high energy linked inflation, and ultimately more FX uncertainty. So, what has been the response from central banks so far? And maybe we start with what you've been seeing internationally across the world.
So just to frame this first block, we're talking about, Cameron, as you introed, that whole panic and kind of reaction to the Iran war front turning into a blockade of the Suez Canal and the limitation of the commodity exports from the Persian Gulf to the rest of the world has created tightness, not just in the resource markets themselves, as every economy across the globe, which vary on a sliding scale on how dependent they are on imports of natural resources that they don't have access to within their domestic, sovereign economies, are on some sliding scale having to react to that tightness, and so that now has trickled in to the central banking layer at like each of these aggregate economies roll-ups of their own local currency system. So you see it in the euro, the ECB, you see it in the Bank of Japan, and we saw it this week at the Fed. So to dive into it, we're going to start with the Bank of Japan today, and we're going to end on the most important one, the developments we saw at the Fed. But to start with, so this morning, Thursday, as we're recording, we got the intervention, right? The FX intervention support from the Ministry of Finance in Japan to strengthen the yen. As we all know, for the last 3-4 years, the yen has been in a secular sell-off. It's been threatening that 160 Japanese yen to the US dollar support line. And the trigger for this intervention, which amounts to central authorities in Japan buying yen and selling dollars. So it's yen strengthening or dollar weakness. We're not going to talk about the DXY index, but or too deeply or throw up the charts. But the pressure here is towards a weaker dollar after we just saw a strengthening impulse in the dollar as that tightness I talked about coming out of the Iran situation worked its way up to a head, and now central banks have to react. So the yen, this was really set in motion by the Bank of Japan's policy announcement on Monday evening on U.S. time, that the Bank of Japan's response to this commodity market tightness and also the tightness in global money markets, short-term access to currencies, dollar, euro, yen, et cetera, for overnight and short-term funding. The Bank of Japan, just to set the stage here, every economy is facing an inflationary impulse, not in the terms of the monetarist definition and expansion and credit and money supply, but in the way that everyday people have been trained to talk about inflation as a rise in prices. But we've seen that rise in prices on the back of this resource tightness coming out of the situation in the Persian Gulf. And every central bank is now having to come up with its own prescriptive plan at these April meetings to address that pressure, right? So the Bank of Japan's approach was they announced that they are going to hold short-term rates steady. They're sitting right now at 75 basis points. And Chairman Ueda elected not to hike 25 basis points on Monday afternoon's policy announcement. And what that led to was, that's the case, right? Because in their summary of economic projections, they increased their inflation target in terms of rising prices in the domestic Japanese economy for the 2026 calendar year, right? So they knew they took this trade-off. We are not going to hike in what is right now a secular hike cycle for the yen. The Bank of Japan is on a hiking path, which is kind of off cycle from what you see in the United States or Europe, right? We were in a cutting cycle, and they're
Right.
like rates are on a downward trajectory on the front end, is where policy naturally needs to go, or where money markets are guiding policy. In Japan, it's the opposite. They're on that hike cycle phase of their own trajectory. So Ueda's decision and the Bank of Japan not to hike in the midst of like a broader hiking tailwind, that itself was a tell that they were willing to play nice with the international community. In my read on this, they were not going. They elected not to increase rates, which pulls capital from the global money markets into their own domestic financial system in the backdrop of an environment where everybody is after the short-term dollars, that monetary tightness, in the face of competition for resources, as one kind of supply nexus is temporarily taken off the board with the Iran and Strait of Hormuz situation. So what Japan did, they decided to play nice. All else equal, you're going to get a rise in inflation in the Japanese economy, which is amidst a broader secular inflationary backdrop in the Japanese economy itself. And the reaction, then the follow through to that, came this morning with the FX intervention to prop up and strengthen the yen. So the last thing the last detail I want to talk about there, the articles, we show this Bloomberg one. We usually don't go through the full text, but they specifically mention before they conducted this activity, the Ministry of Finance, they coordinated and kind of pre-announced it or ran it by their counterparties in the U.S. So Japan, we've talked about this in the past with the Takaichi government. They are simpatico with the U.S.'s 47th administration. It just goes to kind of reinforce that idea that Japan is a friendly dance partner to the U.S., who is the one leading on the steps, Japan kind of following, also kind of dancing on their own and doing what they need to do, but they are a friendly dance partner to the U.S. We'll leave that one there, but it was a big development right here in Japan, that intervention you saw on Thursday morning. This was, rumor, like we've been hearing this rumor of intervention. It was coming. We had that, remember, think it was December or January, we had that rate check conducted by the BOJ officials. This was the arrival here as of this morning, April 30th. All right, next we'll shift focus to Europe and the ECB. They announced at their policy meeting this week they're also not going to hike, but they are telegraphing that, hey, if this tightness persists, don't be surprised if we need to hike in June, is what they're saying. So slightly different than the Japanese perspective of we're going to play nice, we're going to accommodate, but also, hey, we're going to intervene to strengthen the yen as necessary. Europe is everybody's facing their own, unique circumstances as far as their position on the game board and reaction to this acceleration of these bigger picture events unfolding into the next stage, which Iran was the catalyst for, or was a key catalyst. ECB is saying, hey, well, we may start actually hiking rates to accommodate that monetary tightness and drawing more capital into our banking system, our money markets, et cetera, and ultimately strengthening the currency through a different means or mechanism than what we just saw with Japan. But ultimately, what this is signaling in my mind is this policy path is kind of an indication that the ECB officials recognize that their economy is on a much weaker footing from an underlying growth and demand standpoint than, say, a relative peer in Japan. And then if you want to juxtapose that with the United States, just much further behind in terms of the growth potential, demand, underlying, um, strength and resilience. Okay, so just one other piece of information here we've seen in the last week. This isn't central banking, but you saw from Brussels partnership with Frankfurt, where the ECB is based, the technocratic complex from the political bureaucracy standpoint, echoing what you see from the technocratic bureaucracy in Frankfurt from the financial dimension. You saw this program launch with the heading or with the title Accelerate EU in response to this entire resource tightness, the problems with domestic economic growth. And the answer from the EU, as it generally tends to go with the post-war technocratic kind of mindset, was to launch a new program management spin up called Accelerate EU to strengthen EU's energy resilience in the face of tight energy and other natural resource commodity exports from the Persian Gulf. So those two programs working together are kind of a good indication of the cards that Europe, both the ECB and European Union and the European Commission, et cetera, holistically what Europe is holding in this kind of game we kind of analogize to like a poker table all the time, I think is an apt metaphor. But those two were big tells. Yep. All right. Last, let's go to the big kahuna. We're going to talk about the Fed and what we saw at kind of a historically messy April meeting that we just got the Powell press conference on yesterday. So to start with, from the policy prescription and the all the variables that these committees manage on the FOMC, short-term interest rates, balance sheet, runoff or expansion, all of that, no real changes to report. The news here is actually in the political details that really point to a boardroom battle going on for control over the Fed, right? The key monetary policy institution for the United States. So start with a vote. You got 4 dissents. One of them was your classic dissent from Stephen Moran, Trump appointee, who is sitting. I'll just note this because it's important. It'll come up in the Warsh confirmation process as the new chair. Stephen Moran was appointed into a stub term that Adriana Kugler had filled up until August of last year, 2025, as a Biden era appointment into what was already kind of a stub seat. So the term on this seat, these Board of Governors seats, they're 14-year terms, which is like massive, right? In terms of like political seats, it's like, all right, job security. Supreme Court justices for life. Fed Board of Governors for 14 years is like the next highest job security in Washington, D.C., as far as I'm aware. But these things last a long time. Okay, so Stephen Moran's seat that he is occupying on the Board of Governors technically lapsed at the end of January 2026, right? And by convention, like on the FOMC, operating procedure, or what do they call those? Whatever they operate their board by, Robert's rules, whatever. He can sit in the meetings and vote in that seat while not being nominated and confirmed for that new 14-year term until a new appointee is presented by the president and confirmed in Congress to occupy that seat. So right now he's just kind of a holdover, warming that seat as a placeholder on a tentative basis, but he's still showing up and voting in these meetings. And so his vote, he's been in dissent every meeting that I'm aware of since December, where he's lower rates. We need lower rates, lower them more every single meeting. Now, the interesting thing this meeting were 3 dissents from Beth Hammack, Neil Kashkari, and Lori Logan. They're not on the board of governors. They're on the rotating seats for the Federal Reserve Bank presidents. Um, and there's five of those on committee. And what's interesting here is three of those five dissented. So they represent the regional banks that aggregate up into uh, the bigger Fed, right? The central mothership in Washington, D.C. And the other seven board of governors are all political appointees, right? So the interesting thing here is you saw from the regional banks themselves, they actually dissented, but not necessarily on rates or policy themselves, but they supported the decision to maintain the target range for the Fed funds rate. So don't move short-term interest rates at this point from their current levels. They specifically noted that they did not support the inclusion of an easing bias in the statement at this time, right? So opposite of the Stephen Moran dissent, rates need to be lower. Regional banking system is saying, actually, we shouldn't be easing right now, which is hinting at. So if you think about the net dynamics of what's going on, or at least the impact on the United States business, and then that'll translate into the banking layer. Due to what's taken place in Iran and the Persian Gulf situation since February 28th, we've seen this on the charts. All of those tankers that can't, transport commodities, goods out of the Persian Gulf to their normal consumption markets, that demand is showing up in the Gulf of America, loading up oil tankers, loading up, resources for import into other markets around the world. So it's been a positive tailwind from the U.S. business perspective. And what that amounts to is more dollars flowing in to the U.S. Banking systems that these regional Fed presidents are seeing on the ground. They're like, whoa, we're seeing,
A lot of this is
we're
coming in.
seeing,
Yeah.
we're seeing deposits show up. We're looking flush here. We don't need to ease, is I think what I would take away from their first glance statement. They're like, yeah, we don't need that easing bias right now, guys. That is technically different though. That's a supply question of money, but it's different than what the short-term interest rate should be for an ideal monetary policy. Two related but distinct variables here. So
It's a good call out.
there is a way in my mind where both Stephen Moran and the three regional Fed presidents can both be directionally correct here.